Hi, I'm Tom Lydon, editor of ETF Trends here in Hollywood, Florida at the ETF.com conference, and I'm here with Todd Rosenbluth, Director of Research at S&P Capital IQ. Todd, great seeing you.
Good to be here, Tom, thanks.
So let's talk sectors. A lot of advisors are looking at the marketplace in 2015. Based on what's going on economically, there might be some sectors that would deserve an overweight, others maybe an underweight. What do you think?
Yeah, I mean, so sector investing has become increasingly popular, allows you to be more tactical in how you want to build your portfolios. We like some of the more economically sensitive sectors. So industrials, for one, is an example that can benefit as the US economy improves, as we hope to see improvement in Europe and Asia. We also like technology.
So why do you like technology?
So technology companies, we think, have stronger growth prospects than the broader market. Capital IQ consensus data says 2015 is going to be a stronger year than the S&P 500 index, yet that sector trades at a discounted valuation on a PE and a PE to growth basis. So there's lots of good ways to get exposure to technology.
A lot of M&A going on, and they've also got some cash on hand.
Yeah, and so they've been doing a couple of things with that. One is they've been making acquisitions, as you mentioned, and we think hopefully smart acquisitions, but they're increasingly returning money to shareholders through dividends. So you actually get a dividend component through technology and not just the growth perspective. And that's a lot better than some of the dividend sectors like utilities that we happen to not like at S&P Capital IQ.
Okay, so what about from a valuation standpoint? What areas are a little rich? And number two, what areas might get hit harder if we start to see a hike in interest rates?
Yeah, well actually those things are perhaps the same thing. The higher dividend yielding sectors like consumer staples or utilities, we think are trading at a premium valuation than is warranted. Utilities, for example, XLU was up 34% in 2014. Slow, stodgy utility companies really didn't have any reason to do that. A number of the stocks in XLU are overvalued according to our research. We think that's an ETF you want to have underexposure to versus the broader market. Not going to do well in a rising interest rate environment as that yield looks less competitive.
All right, great. Any other high flyers out there when you look at the sector landscape that we should take note of?
Well, you know, we think home builders are actually going to do very well, and that's a subset of the consumer discretionary sector. Home durables and home builders, we think are going to do better as the housing recovery improves, and there's actually lots of clean ways to get exposure. iShares has a product, State Street has a product that is concentrated in those respective sub-industries. We think that'll do well in 2015.
Great stuff. Thanks, Todd.
Thanks, Tom.
Appreciate it.